When a billion-dollar company finally collapses, the public wreckage is always the same. Portfolios are zeroed out, panic sets in, and retail investors are left staring at screens, wondering how a seemingly stable giant shattered in a single afternoon. Institutional players on this street watch the data accumulate for months. By the time the ticker hits zero, they have already processed the signals that most people missed. The smart money identifies structural damage long before it reaches the headlines. They quietly reposition their capital, leaving less informed participants to hold the remaining shares as the company's value evaporates. Public filings track the exact health of a company. Identifying 7 specific metrics provides the context needed to separate a temporary dip from a structural failure. Retail investors who ignore these metrics often find themselves providing the liquidity for the professionals who are already exiting the position. The first stage of decay is often hidden by branding. A failing company can still operate out of classic architecture and run expensive marketing campaigns that project absolute stability to the public. Beneath that exterior, however, the balance sheet often tells a different story. Red flag number 2 is an aggressive accumulation of debt that outpaces the company's ability to grow. This imbalance is measured by the debt-to-equity ratio. When the liabilities outweigh the equity to this degree, the company's survival becomes dependent on the mercy of its creditors rather than its customers. Excessive debt often leads to our 4th red flag, negative free cash flow. This occurs when a company burns through its cash reserves simply to maintain day-to-day operations. A business with escalating debt and negative cash flow faces a narrow path to survival. Without a significant shift in operations or a massive capital injection, these 2 factors create a compounding drag on the stock's viability. Amateur investors often overlook this internal rot by focusing solely on profitability, a number that can be heavily influenced by accounting adjustments. This chart highlights the 3rd red flag. The bright line shows reported profit, which can fluctuate based on tax credits or one-time asset sales. The secondary line tracks actual revenue, the total sales generated by the business. A widening gap between rising profits and falling revenue suggests that the company is using accounting maneuvers to hide a shrinking customer base. This brings us to the 5th red flag, an overvalued price-to-earnings ratio. Investors often pay a premium for these stocks, assuming that a high price reflects high quality. A PE ratio is only meaningful when compared to the industry average. If a company is trading at twice the valuation of its peers while its sales are declining, the price is detached from the underlying business. When market valuation inflates while core sales shrink, the stock becomes a high-risk asset disguised by a premium price tag. As the internal rot worsens, the people with the most direct knowledge of the company's struggles begin to reduce their exposure. This is our first red flag, insider selling. While executives sell shares for many reasons, a synchronized exit by multiple C-suite members often signals that those closest to the operations lack confidence in the company's future. Investors can monitor these trades through mandatory filings with the U.S. Securities and Exchange Commission. These documents provide a transparent record of whether leadership is buying or selling their own stock. Following the insiders are the major hedge funds. This leads to the 6th red flag, institutional selling. Because these funds hold such large positions, they cannot sell everything at once without crashing the price. Instead, they sell in small increments over weeks or months, allowing their capital to trickle out of the market quietly. By the time the public realizes the smart money has left, the exit is already complete. For large institutions to exit their positions, they need a high volume of buyers on the other side of the trade. This is where we see the final red flag, media hype. When a stock is being aggressively promoted by influencers and news outlets, it often creates a surge of retail buying. This euphoria provides the liquidity that professionals use to finalize their exit right before the trend collapses. Professional investors treat widespread buy now signals as a contrarian indicator. They recognize that when the public is most optimistic, the risk of a sharp reversal is often at its highest. If you are only hearing about a stock because of social media hype, the primary growth phase has likely passed, and the risk of being caught in a sell-off has increased. Most investors approach the market looking for reasons to buy. They search for growth stories and optimistic projections, often ignoring the structural weaknesses in the process. The most successful capital managers do the opposite. They look for every possible reason to disqualify a company from their portfolio. Using these 7 red flags as a filtration grid allows you to clear away the companies with toxic debt, declining sales, or insider flight. This process ensures that only the businesses with the strongest fundamentals remain. Adopting this mindset shifts the power back to you. It replaces emotional decision-making with a mechanical process designed to protect your capital from market cycles. Professional capital stays protected through a process of risk exclusion. Subscribe to Intel Shift to learn the filtration methods Wall Street uses to protect its own portfolios.